afternoon and welcome to the latest episode of Tea with the Trustee. Today we're going to discuss the DB Funding Code consultation. My name is Judith Fish and I'm a professional trustee with Dalriada Trustees, working across a range of pension schemes, both as a co-trustee and as part of the sole trustee team. I have been working in pensions for over 25 years, and prior to joining Dalriada last summer, I worked as both a scheme actuary and a corporate actuary, advising a range of schemes and sponsors, and more recently in-house. I am joined today by my colleague Charles Ward.
Good afternoon, everyone. My name is Charles. As Judith says, I act as a professional trustee to a portfolio of schemes, which are also a mix of sole trustee and co-trustee appointments. I joined Dalriada in November 2019, and again, my background is actuarial consulting. Most recently, my focus was on advising companies and trustees on long-term funding and investment strategies for their schemes, with a particular focus on the settlement market. Since joining Dalriada, I've also taken responsibility for our approach to the settlement market, including the emerging consolidators and capital-backed solutions, which are all very relevant to the conversation we'll be having today. I also spent time as a scheme actuary for a portfolio of schemes covering a range of different funding positions and employer covenants. So I'll hand back to Judith to talk about where we are on funding at the moment.
Thanks, Charles. To provide some background, we thought it was worth looking at where we currently are regarding scheme funding. As you know, schemes are required to undertake a valuation at least every 3 years, and the trustees set the assumptions underlying their technical provisions or liabilities on a prudent basis. The current regime is referred to as scheme-specific funding. Each set of trustees will look at the details of their scheme, including the strength of the employer covenant and the current and expected future investment strategy, when considering the basis for setting their technical provisions. When setting their funding assumptions, most trustees will also consider what they expect their end games to be. Are they expecting the scheme to go on, to run the scheme on for a foreseeable future, or are they targeting buyout? When setting the recovery plan, trustees have to consider employer affordability and the future business plans, as well as being cognizant of the risk of covenant leakage, with the emphasis on seeking a fair deal for the scheme. In more recent years, a pension regulator has provided greater guidance in its annual funding statement on how trustees should be approaching valuations and recovery plans, depending on the strength of the employer covenant. In this guidance, the regulator has started to categorise employers from A1 to E2, depending strength of the employer covenant, strength of the funding basis, and scheme maturity. And depending on the categorisation, sets out what it expects trustees to do when negotiating the recovery plan. This guidance has also extended to the regulator's views on the wider economic conditions, including Brexit and more recently COVID, and how trustees are meant to navigate these difficult challenges. This has provided useful guidance to trustees in navigating funding in difficult and uncertain times. As part of the current regime, trustees are expected to have an idea of where they're aiming for, as I mentioned, and this is called the long-term funding target or long-term funding objective. Pension regulator keeps on changing its terminology, and trustees should also have in place an integrated risk management framework to deal with any unforeseen changes along the way. Because of the focus on funding being scheme specific, you can find that trustees of similar schemes can be taking often very different approaches to funding. This may well be appropriate depending on their covenant and their journey plan, but it must make it harder to regulate for the pensions regulator. So this is where we are. This is the current framework in which we're funding schemes. Now Charles is going to talk about what has been changing and what further changes a new funding code is expected to bring.
Thanks, Judith. Before I talk about how the consultation has changed how conversations are happening between trustees and sponsors, I thought it would be worth recapping on what's actually included in the consultation, which broadly comes under 8 different headings. So firstly, TPR is expecting compliance and evidence, so ensuring that trustees manage their risks and importantly demonstrate how they've managed those risks within the pension scheme investment and funding strategy. Secondly, there's an expectation that trustees and sponsors will set a long-term objective for the scheme, which is fairly self-explanatory and something I think is fair to say schemes have been doing for a number of years now, albeit maybe on a more informal basis. Thirdly, the journey plan to get there and setting appropriate technical provisions to support that journey plan. What I found interesting about this part was the focus on implicit de-risking of the investment strategy over time, which is something that TPR has not been as explicit on in the past. Many schemes will have de-risking journeys, but it's the first time we've seen a ramping up of pressure to introduce that into strategy. Fourthly, the alignment of scheme investments to those journey plans and long-term objectives. Again, slightly different focus here in that TPR is expecting us to look at where we'll be at the end of the journey as much as how we'll get to the end of that journey, something that trustees maybe haven't given too much thought to beyond what the target should be. Fifth, employer covenant and visibility. And again, a slight change in approach here in that TPR is encouraging trustees, as they have for some time, to look at sponsor covenant. But importantly, they're asking trustees to make the assumption that covenant diminishes over time, and therefore the reliance on the sponsor should diminish over time. And they talk about a 3 to 5 year period, which again is not something that's been brought into valuations before now. And scheme actuaries, I think, have always assumed that contributions in the recovery plan will be paid with no real regard for employer covenant in the longer term. So interesting change of approach there, which is linked to the sixth point around additional support, particularly bespoke contingent assets and means of supporting the schemes in the event the employer covenant isn't there in future years. Seventh, appropriate recovery plans. Again, we've seen this guidance for some time. There's no huge change here, but what we are seeing is a bit of a ramping up of pressure on stronger and very strong employers, looking at kind of 6-year recovery plans as a benchmark. And finally, open schemes having their own special mention, which Judith will come back to on one of the questions shortly. So in light of the above, I thought it was interesting just to reflect on how we've seen conversations change between scheme sponsors and trustees over the summer, even though this new guidance is not yet in place. I think the first point is that this has been influenced to a large degree by COVID and the impact that has had on schemes. Certainly earlier in the year, when the crisis first hit, we started to see more information sharing from sponsors, prompted largely by pressure on trustees to understand the position of the sponsor, the cash position, and the ability of the sponsor to survive lockdown. However, once that was understood, for many of my schemes, those conversations have carried on over the summer, and now there's much more open sharing of conversation between trustee and company. Having raised the bar in this area, I do expect that to continue, and we'll come on to talk about how that will be an important part of funding discussions this year and into future years. The second area where we've seen a change in approach is around long-term planning, this concept of the longer-term goal and the journey plan for getting there. I think scheme maturity is certainly something that's triggered more and more of those conversations with schemes increasingly comprising pension liabilities. There's an increased focus on how to manage the assets in a sensible way, not always towards perhaps the assumption of buyout, but also looking at consolidators or other solutions such as self-sufficiency. So I'd say in light of all that, sponsors are far more engaged and willing to talk to trustees about the long term and how employer covenant can impact on that. TPR's consultation will inevitably change the focus. My main concern on the consultation is that it results in a more rigid framework, which may result in bad behaviours or put employers off having those conversations with trustees. So on that note, Judith, how are you seeing this manifest in negotiations between scheme sponsors and your schemes?
Well, I've been involved in a couple of recent funding discussions, and I agree that the focus on schemes to look at their long-term funding target is extremely helpful, particularly now that the majority of pension schemes are closed to future accrual and are maturing quite quickly. I think the long-term funding target and the new code will stimulate further frank conversations between employers and trustee about where they're heading to. But it's still early days, and it's unclear where the regulator will land in respect of fast track and the impact this will have on valuations in the future. But whilst the funding regime hasn't come into force yet, we're already seeing it impact funding negotiations. So in particular, we're seeing a move away from relatively high single discount rates at all durations, which have been based on a diversified portfolio of assets, to either a term dependent discount rate or a split discount rate. Employers, I think, can see the writing on the wall, and where there's a single discount rate approach that was used in the past, that this is unlikely to be accepted at the next valuation, and they're open to making changes now and think about their journey plan. In some of the recent valuations I've been involved in, we have been having more open conversations with the employer about that expected long-term goal for the scheme and how we expect to get there. Whilst our approach have always been collaborative and working with the employer, I think the consultation has brought greater focus on the long term, which has been helpful. So what have I been seeing? Well, as I mentioned, we've seen some schemes move to a term dependent discount rate, where the discount rate reflects an investment strategy that is expected to change over time and de-risk. So typically this is a move from a kind of the current investment strategy, which is relatively risky, to a materially de-risk investment strategy by the time reaches that kind of that notion of significant maturity. We're still not quite sure what that means, but for this point, for this purpose, we'll assume peak cash flows. So when considering this, we've been having a look at what that long-term de-risk investment strategy might look like and how we're going to get there. So particularly how that journey plan is going to move over time. Are we assuming that it's a gradual de-risking, or are we making a stepped approach to that long-term investment strategy? And then that then influences the discount rate. So the discount rate we use is based on that similar de-risking path of the assets. So now we know that, you know, the future is never going to be in line with the assumptions that the scheme actuary makes. Both having been scheme actuaries, I think we're fully aware of that. But, you know, in an ideal world, this will mean that these schemes that are following this de-risking path and this strategy will eventually be fully funded on a de-risk funding strategy with a matching de-risk investment strategy. And that will happen by the time they reach maturity, which I think is very much the focus where the regulator is going to with its current consultation. Other schemes, we're seeing a move to a split discount rate. So this is where a lower discount rate is being used to value post-retirement liabilities. So by the time most members are pensioners, we will also be funded on a de-risk basis. The other impact we've seen is for schemes with a secondary funding target. So that used to be a way in which some schemes used to explain their long-term journey. They used to have a secondary funding target that said where they were heading to. We're now seeing that integrated into the technical provisions, because it doesn't really make sense to have it as a separate funding target when they know that the pension regulator really wants them to include that in their technical provisions going forward. So these are the changes we've been seeing so far. So already quite a lot of move, I think, towards where the pension regulator is going to from its consultation. And obviously, we'd be very interested in the experience of all of the participants on this call today. We're now going to have a look at some of the questions that were raised prior to the webinar, but we'd be really grateful if you would submit further questions in the Q&A panel.
Okay, so we start with the questions we received in advance, Judith. Firstly, how do you feel the funding code treats open DB schemes?
Yes, so that's quite a difficult question. Schemes that are both open to accrual and open to new members are rare. And the funding code is looking to ensure that schemes are funded on a prudent basis when they reach significant maturity, taking minimal investment risk and with limited reliance on the employer covenant. For open schemes, the term to reach significant maturity is likely to be further away. And where you have a steady stream of new members, you might never get there. This should allow the trustees to continue to have flexibility over funding and investments. For example, if the scheme is not maturing, then arguably it shouldn't need to de-risk its investment strategy. But the regulator in the consultation also stresses that members' accrued benefits should be protected in the same way as in open schemes as there is in closed schemes. And they also state that the new funding framework shouldn't lead to unnecessary scheme closure by unduly increasing the costs of running the scheme. I'm not sure how these two differing objectives are going to work together in practice. For open DB schemes, the trustees are still going to have to set a long-term funding objective and fund in a manner consistent with this. At subsequent valuations, if they haven't matured any further, then arguably we would expect that they could effectively reset the clock and not have to assume that they've already gone down their de-risking path. One way to reflect the open nature might be in the recovery plan and perhaps allowance for outperformance and maybe continuing to hold a fairly risky or certainly not de-risked investment strategy for longer, and even with the option of back-end loading of contributions. I think that in summary, there are still outstanding questions of how funding of open DB schemes will comply with the new code. And whilst I can appreciate that the regulator wants accrued benefits in open schemes to be funded to the same standards as in closed schemes, it would be a terrible shame if the funding code led to good quality open schemes closing in the future. This is all based on what we've seen so far. Obviously, we've only seen the first consultation. We have a second consultation, which hopefully will provide a little bit more colour and more detail of how open schemes are going to be able to comply with the funding code without leading to unnecessary prudence and higher costs. So that was one of the questions that was raised prior to the webinar. We have another question here, which I will ask you, Charles. What are your thoughts on the potential fast track parameters and what could be done to prevent minimal regulatory compliance?
Thanks, Judith. I mean, we don't yet know exactly what those parameters are likely to be, but there is general consensus that the regulator's been looking at a discount rate in the range of gilts plus a quarter to gilts plus a half, which based on our experiences is definitely towards the more prudent end of what we see as a low dependency target. So in light of that, I think my view is that minimum compliance isn't really the main risk that we should be concerned about. The two key risks that I see are, firstly, if we do end up with a longer term framework that encourages funding to maybe gilts plus a quarter, this is a pretty prudent target and could lead to overfunding. Now, from a trustee perspective, this obviously isn't a bad outcome in itself, but I think the behaviours it might drive are potentially problematic. So certainly by encouraging very prudent funding, that could result in reluctance from employers to fund schemes appropriately, and the likelihood being that employers will look to provide kind of ancillary support rather than direct funding into the scheme, which obviously then raises costs all round for managing those contingent contingent assets. There's also the point that as schemes become increasingly mature, the cost of buying out benefits, as we've seen over the last few years, actually is cheaper than potentially that long-term target suggests. And so it's not just a conversation around trapping surplus in a scheme on an ongoing funding measure, but potentially trapping surplus beyond buyout, which again, from a trustee perspective, if the powers are there to enhance benefits, potentially is good news. But it can be a problem where scheme rules are more involved and more complex around the treatment of any surplus that arises. And finally, just picking up on your point on open schemes, open to future accrual, a high funding target inevitably will lead, in my view, to another wave of scheme closures. The second area where a high bar might be a problem is around investment risk. By encouraging a high long-term target and a pretty low risk investment strategy from there on, that does incentivize a higher risk approach to investment in the short term. So essentially, I see this as a sprint rather than a marathon, which introduces its own risks. And generally, that potentially flies in the face of some of the spirit of this consultation, which is basically seeking to help schemes work towards a smooth landing on their liabilities. Having said all that, there is the possibility that the parameters will be less prudent, and the key risk there from a trustee perspective is obviously that members fail to receive the benefits they've been promised because employers do gravitate towards that lower end. But I know it's a question you'll deal with in a moment, Judith, so I won't talk too much about that. Key point really, again, coming back to each scheme being scheme specific and ensuring that the objective that's in place for each scheme is appropriate for that scheme, almost regardless of what the fast track parameters might encourage. I'll move on to the next question, as I'm conscious we're getting a few more questions in. So another kind of question asked in advance was, do you think the governance burden for small and mid-sized schemes is appropriate, is proportionate to the value it adds, both in terms of funding and ESG?
Thank you, Charles. Running a DB scheme is certainly not getting any cheaper. And year on year, there seems to be additional burden placed on sponsors. Two have been raising this question, but we could also raise GMP equalisation, the dreaded word, where the majority of members will see little uplift, but the cost to the employer can be quite material. Returning to the question, the regulator, I think, sees fast track as an opportunity for small schemes to comply with the funding code in a cost-efficient manner. Therefore, where a scheme can comply and go down fast track, we expect them to do so they don't spend money unnecessarily on advisor fees. However, we all know that there are quite a lot of schemes out there that aren't well funded and where the employer perhaps isn't as strong as the code would want them to be, and they don't have a choice other than going down the bespoke route, particularly when it comes to length of recovery plans. And, to comply with bespoke, there's going to be a cost. The cost of the valuation is going to increase. And I guess my fear is that this might mean for very small schemes that it might have the opposite effect of that intended by the funding code and actually lead to a reduction in security of member benefits rather than increasing it, because there's less money available to fund the scheme because more money is being spent on advisor fees. So, but I think that, this is an area we'll have to look at as it develops over time. To make sure that we are controlling costs in a way that is proportionate. The second part of your question is around ESG, and I note that small and medium-sized schemes tend to invest in pooled funds where they have limited influence over what the investment manager invests in, and often the funds will simply be tracking an index. Clearly, it's good that trustees are having more conversations with their managers over engagement on ESG matters, and that manager may well have influence, even if the scheme itself doesn't. Over recent years, we've seen, an influx of ESG funds or funds with ESG tilts, which are also tracker funds, although they avoid investing in certain companies, and they have a tilt to to companies with higher ESG scores, I guess. And they are still relatively cheap to invest in, although I would note that they are slightly more expensive than the regular index tracker funds. And I guess here that for trustees, the problem is that the investment industry, all the ESG funds feel very much in their infancy still, and there's no agreed definition of what a good ESG fund looks like. And I think it's quite difficult for trustees to measure up which type of tilt is the appropriate tilt for them. For larger schemes, certainly they are able to have segregated funds, particularly in equity markets. They can make much more meaningful decisions regarding ESG. We do believe that companies who take ESG seriously are expected to deliver higher returns over the long term. Therefore, although there is a cost to compliance with the new ESG requirements, this should be recovered in the long term from higher investment performance. It should also be noted that for the very smallest schemes, they don't have to comply with some of the new ESG requirements, such as producing implementation statements, which I think is quite helpful. So it's more, it only impacts those schemes that are slightly larger. I guess finally, I wanted to say that the one consequence of the higher cost of compliance may be that if employers are putting more money either in their schemes or running their schemes, there might be less money available to either invest in the future of the business or pay into their DC schemes. We often forget the poor DC schemes that are there supporting their current employees. This will exacerbate the difference between those with DB benefits and the younger workforce who may only have DC benefits. Unless there's a shift with more money going into DC schemes in the future, we're going to see an increasing number of people unable to afford to retire. And whilst that may be some years away, I feel that inadequate pension provision is a real risk that we face. Okay, so Charles, the next question I wanted to ask you is, do you expect many schemes to go down the fast track approach, or do you think most schemes will use bespoke?
Yeah, based on our experience and also the various kind of surveys from the consultants that we've seen, it seems to be that we're expecting about half and half based on the current, maybe a gilts plus a half parameter. But it does very much depend on where that fast track framework ends up. And there will be inevitably a fair proportion of schemes who have no choice but to go down the bespoke route, particularly those who have weaker sponsors. As Judith alluded to in an earlier answer, I do worry that the extra work needed to justify the bespoke route could actually end up being quite detrimental in terms of the amount of deficit contribution that can be paid into the scheme due to additional advisory costs. So there is a risk there for smaller schemes in particular. I think for those going down the bespoke route, again, that probably splits into two categories. There are those that will be tweaking around the edges, so looking at slightly longer recovery plans, or possibly not fully reflecting TPR's objective of a full de-risking plan on the investment side. So I think those will be a bit more straightforward to get through the filter at TPR. But then I'd probably say there are maybe 20-25% of schemes that probably will go down the bespoke route by choice. And interestingly, I'll try and answer two questions at once here, because I noticed there's a question on the chat about TPR's fixation with gilts plus as a benchmark. I do see an increasing subset of schemes looking at credit-based investment, particularly as schemes mature, to try and move to more of a cash flow matched approach to funding rather than a gilts plus, kind of implicitly assuming the scheme will buy out at some point. So particularly for larger schemes, the credit-based strategy is something that could run on for quite a number of years. So I do think there will be quite a reasonable number, possibly towards the larger end of the scale, that look to go down the bespoke route, really to reflect their beliefs on the investment side, but also to reflect the fact that, as schemes mature, more and more schemes will be holding credit type assets in order to meet cash flows rather than the more traditional investment approach we've maybe seen to date. So the final question we had in advance of the session today was, for schemes that are already ahead of fast track, Judith, do you expect to receive pressure from sponsors to reduce the level of prudence in those funding targets?
I think that there's always a risk that some employers will see this as a way of paying less into a pension scheme where they are funding to a more prudent level than fast track. But I know I have some schemes that I think will go down the fast track route that might well be ahead. And for those schemes, we have a defined journey plan, so we know where we're going to. And it wouldn't make sense for us to change our funding plan, because that would take us off track from our end game strategy. So, I'm very confident that on these schemes that we won't change our funding target just because of the funding regime. We won't unnecessarily weaken the position that we're currently in. But I think that it's naive to think this is going to be true in all cases. So I think that my advice to trustees is know where you're heading to and make sure that your funding plan is appropriate for that. And if it is, then you're doing the best you can to ensure that members' benefits are paid fully when they fall due. Okay, so that was the end of the questions that we were asked ahead of the session, and I think Charles managed to wrap up the Q&A question during his answer to the last question. If there are any other...
Sorry, Judith, there's just one there in the chat box. So there may be another one coming in here and there, but just while we wait to see if anyone else has got any more questions, there's one to say, do you imagine the focus towards shifting to shorter recovery plans shifting as a result of COVID? I think that's kind of in response to what you were saying earlier, Charles.
Yeah, no, I think that's a very, very good question. I think there will be an extension of recovery plans generally in light of what's happened this year. I think it'll be quite interesting how TPR takes account of that in the next round of consultation, because clearly they had an expectation. I mean, the bigger factor for me is scheme maturity. I know TPR uses that as a benchmark in the consultation, but to me, schemes will at some point have to pay out benefits, and that really is to me what sets the timescale for getting to full funding, rather than what it says in the consultation. So I do see a potential lengthening of recovery plans, but as I say, potentially driven more by maturity rather than the guidance from TPR. I'm just conscious it's 4 o'clock, Susan. Are any more questions?
No more questions. No more questions.
Well, I'll just say thank you to everyone for attending today. We really appreciate your attendance. We will send a link of the recording to everyone who's registered for the accounts, for the event, sorry. And please let us know if you do have any feedback at all, or if you have any ideas for future topics. Otherwise, I wish you all the best for the rest of the day. Thank you very much for coming.
Goodbye.